Hi, and welcome back to Mike on Money. My name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management. And as always, every week, we like to do a dive into a topic that will help you with your financial planning, your investment strategies, and anything that gets you to where you want to go. So with that, as always, remember this is for information purposes. We try to be as accurate as possible, but is not advice. Don't take it as solicitation. Always do your own due diligence or seek the advice of a professional about your specific situation before enacting any strategies. You can reach us at mikeonmoney.com. Happy to answer questions, have a one-on-one with you, answer questions directly related to your situation, your portfolios, and just help you along your way in any way we can. So with that, what I want to talk about this week is Tesla. Something that's very high in everyone's minds these days, especially when we've looked at what's been going on in the markets with Tesla. It's a very interesting case study story of what opportunities, but also pitfalls, things not to do. There's been some really great money made at Tesla, but there's also been a lot of money lost at Tesla, on Tesla. So let's take a look at that history of that story. So I'm just going to go back to more recently, 2018. Of course, that's when a lot of this all kind of came to the forefront. Certainly not the Tesla story. It's been around for a while. The success, I mean, we've all seen the cars out there, and Elon Musk is certainly out in the forefront of social media. And that's kind of where I'm starting that story in August 2018, that infamous tweet that Elon put out saying that he was looking at taking the company private, and he had secured financial backing that he was going to take the company private, and I believe the share he was going to take it at about $4.20 a share was the dollar value. So there was a big settlement with the SEC in the U.S. over whether that was a misleading statement or a true statement. Anyway, Elon had to pay $20 million in penalties. Tesla had to pay $20 million in penalties, and Elon stepped down as chairman for 3 years. As part of that settlement, and his Twitter account had to be monitored by the company. So I'm just going to start the story there. I really don't want to talk about that situation. It's kind of ancient history, 2018 now. We're into September 2020. But that kind of set off something in motion. So what we saw is obviously on that announcement, we saw the stock go up. And then when that financing came out to be either not true or it wasn't coming through, or at least didn't happen, what we saw was the stock go down. And basically, we saw the stock go down to roughly the 250 mark, $250 US a share. And, still from its early beginnings, it was a great performance stock. But it had a really struggle through 2018. Then we got into 2019. There were some concerns around the Model 3 deliveries. And as usual, Tesla has surprised on the upside of sales year over year. They've surprised on the deliveries year over year. They've been true to their quality. So I don't want to bash the company in any way. I actually really like it. And we started to see a big improvement in the stock. In fact, that 250 started moving its way up. It got up to $400 or $500 a share. And what we started to see happen in there is shorts positions started to come out. So that's where companies were investment managers, portfolio institutional managers, individual retail clients started making bets against the stock. And that's not new for any big growth stock company. That's very common, but the positions really started to build against it. In fact, it got to a point, it was the highest shorted stock in the US, which, given that the shares during that period went from that $500 a share to $800-900 a share in a very short period of time in 2019, a lot of people started losing money. So anyone who was long the position, who just owned the shares from 500 to 800, were very excited. Obviously, if you were short the shares, you just lost $300 a share during that same time period. Now, the shorts kept going, and the stock kept rallying to $1,000 a share, $1,200 a share. In fact, it kept going to just recently. Tesla announced that they were splitting their shares 5-1. The split happened. The shares rallied to about $500 a share. So working back to the old share price, that puts it at about $2,500 a share, but trading at 500 because if you had one share before, you now had 5 shares. So pretty simple. That the massive rally in that stock from 250 to 2,500 in less than 2 years is an incredible performance. The big surprise there, twofold. One, of course, we saw the shorts build up on those. A lot of people took big hits. A lot of people had to unwind those shorts, which caused the rally. Because to unwind those shorts, of course, you have to go buy the stock out into the market. So that drove up buy demand, driving the price up even further as that happens. So the shorts got hurt pretty badly. People who were long the position did amazingly well, which is why the story is so interesting. But really, when you look at the fundamental, why were there so many shorts? Why were there so many longs? And that's the really interesting part. The shorts were there obviously because they didn't believe that the company could sustain that growth for that long. And why not? Well, take a look at the EV market, the electric vehicle market. More and more entrants are coming into the market, so that more and more competition. There's a lot more price pressure in the market. There's a lot of pressure to bring the entry level or the cost of the vehicles down, so more and more people can access them. There's obviously a lot more charging stations, a lot more availability for people to buy one and still be able to charge it, whether they're in condos or public parking spaces. There's just a lot more acceptance and a lot more demand on the consumer side. So that's what was pushing the stock up. But the short sellers were basically saying Tesla was going to start losing market share, which makes sense. You have all these new entrants. Why wouldn't they? Tesla's kept pushing for more and more market share to be the premium, to be the main product in that space. And they've done a good job of that. They've come out with their Model X, their Model Y. Of course, the 3 was out. They have the new Cybertruck coming out. Elon's always in the forefront of the news. So the sales kept continuing. But that 2,500 peak, now it has pulled back since then, but that 2,500 peak, or at the time of this filming, that was the peak. That $2,500 a share peak from that 250 during a period where we had a pandemic, we had manufacturing closed down. So there was the whole history and controversy around Tesla's manufacturing closing down, possibly moving their plant from California to Texas. All that happening. Car sales obviously came to a slamming halt. I think the numbers, not strictly for Tesla, the numbers for car sales dropped for about 75% during the pandemic closures, and they're just starting to come back now. They're nowhere near moving the inventories they had. All that would say that Tesla should not have grown nearly close to that amount. So what drove that buy side? Well, that's the other dangers. We saw a lot of retail buyers. So these are non-institutional, non-portfolio managers, people at home, people getting caught up in that growth story, people getting caught up in that momentum where they're just buying on the name. Now, that's not to say they're going to get hurt, but it does create a danger where we get a big overvaluation in a very short period of time. And whenever we see any signs of weakness in the market, that's going to start selling off really fast. And it's going to be those late investors, those late comers that get hit the hardest and lose the most. And probably the people who have the least to lose, who are going to get affected by that pullback or those losses. And even in the last few days, we've seen Tesla pull back quite a bit, about $100 a share so far, again, at the time of filming. So keep that in mind when you're looking at a growth stock. When you see a big run up in a chart, really look at what's causing that run up. Is it sustainable? Is it going to plateau where you can perhaps enter in at a much more stable level? What are understanding the short sell market and how that can drive up prices when they start to cover. the Tesla story is very indicative of other big run-ups and massive pullbacks that we've seen in the past. So just caution people. I think it's an interesting case to look at. If you have it in your portfolio and you've had it long in your portfolio, congratulations. I'm sure you've done very well with it. If you've bought it more in the later stage of the pricing, I'd be a little cautious if I were you. I'd really take a really close look at the risk in your portfolio and your exposure there. Not saying it's a bad name. Like I said, I really like the company, but I'd be really cautious on where you're buying that stock, or any stock like that that has a graph that looks like that. So with that, that's the Tesla story to date. We'll try to bring you updates as it continues to unfold, but there's been a lot of talk of it, and I wanted to give everyone some background behind it. If you have any questions or you want some more specific information around Tesla or anything else, always visit it at mikeonmoney.com. You can email us there. You can give us a call. Always happy to answer any of your questions. And if there's anything else you'd like us to see us take a deep dive into, as always, send in your comments, send in your emails. We're happy to address anything of your interest. With that, take care and talk soon.